Title: Unveiling the Enping Financial Crisis of 1997, Lessons from Asia's Economic Turmoil. Introduction. In the annals of financial history, the year 1997 holds a special place as a time of great turbulence in the Asian economic landscape. While the Asian financial crisis of 1997 is widely recognized, a lesser-known but equally significant crisis, the Enping Financial Crisis, unfolded simultaneously in China's Guangdong province. This article explores the Enping Financial Crisis and its intertwined relationship with the larger Asian financial crisis, shedding light on the underlying causes, consequences, and valuable lessons learned from this pivotal moment in economic history. The Asian Financial Crisis, a regional catastrophe. Before delving into the Enping Financial Crisis, it's essential to understand the backdrop against which it occurred, the Asian Financial Crisis. Beginning in mid-1997, a series of currency devaluations, stock market crashes, and economic downturns swept across several Asian nations, including Thailand, Indonesia, Malaysia, South Korea, and the Philippines. These events sent shockwaves throughout the global financial system, exposing the vulnerabilities of the so-called Asian tigers, once thought to be unstoppable economic powerhouses. The crisis was triggered by a combination of factors, including 1. Currency pegs. Many Asian countries had pegged their currencies to the US dollar, making them vulnerable to fluctuations in the dollar's value. 2. Overborrowing. Excessive borrowing by both governments and private corporations led to unsustainable levels of debt. 3. Lack of transparency. Weak financial regulation and a lack of transparency allowed risky lending practices and speculative investments to flourish unchecked. 4. External shocks. External factors, such as the devaluation of the Thai baht in July 1997, ignited a panic among investors and triggered a massive capital flight. The Enping Financial Crisis, a hidden chapter. While the Asian financial crisis unfolded on a regional scale, a lesser-known crisis was quietly brewing in Enping, a county-level city in Guangdong Province, China. Enping had become a hotspot for speculative real estate investment, fueled by the booming property market of the 1990s. The local government encouraged this frenzy by offering favorable land policies and low-interest loans to developers. However, the speculative bubble inevitably burst, leading to the Enping Financial Crisis. Key factors contributing to the Enping Financial Crisis included 1. Real estate speculation. The local government's encouragement of real estate speculation led to overinflated property prices, which were unsustainable in the long run. 2. Bad loans. Local banks were burdened with a significant number of non-performing loans, primarily related to real estate and infrastructure projects. 3. Economic dependence. Enping's economy had become overly reliant on the property sector, making it highly vulnerable to a market downturn. The interplay between Enping and the Asian crisis. While the Enping financial crisis might seem isolated, its connection to the broader Asian financial crisis is undeniable. The bursting of the property bubble in Enping had ripple effects throughout the region. As property values plummeted and loans went bad, Chinese banks were strained. This, in turn, affected international investors who had exposure to these banks, exacerbating the ongoing turmoil in Asia. Lessons learned. The Enping financial crisis, though often overshadowed by the larger Asian financial crisis, provides several valuable lessons. 1. Diversification is key. Over-reliance on a single industry, such as real estate, can lead to economic disaster. Diversifying the economy can help cushion the impact of a sectoral downturn. 2. Transparency and regulation. Strong financial regulation and transparency are essential to prevent reckless lending and speculative bubbles from forming. 3. Currency management. Prudent currency management and flexible exchange rate policies can help countries withstand external shocks more effectively. Conclusion. The Enping Financial Crisis of 1997 serves as a poignant reminder that even smaller, less publicized financial crises can have far-reaching consequences. Its intertwined relationship with the broader Asian financial crisis underscores the interconnectedness of the global economy. By learning from the mistakes of the past and implementing sound economic policies, nations can strive to prevent such crises from recurring and foster more stable and resilient financial systems.